All right, that's the market open for you. Let's check in on the frontline index rates. And as things stand, well, it's a bleakish start. So nothing to really go by. No major moves on the upside or downside. Flat at best. You got the advanced decline ratio, though that continues to favor the gaining side. So take a look at that. Meantime, just let's pull up some of the heavyweights, whether or not we're seeing support coming in from yesterday's Reliance Industries, whether or not you've got an HDFC Bank performing, what's going on. The IT sector, though, has gotten off to a start on the back foot, so that index is under pressure. What's going on then when it comes to a Bajaj Auto? Do remember, you had the overall revenue growth, which scaled up nearly 30% on year. Margins as well have improved, and no wonder then that investors are cheering this one. Lotus Labs, a quick check-in on that stock, given that we were talking about how the pre-open rates as well were indicating a gap down. No surprises then to see that 6.5% gash there on a Lotus Labs. Meantime, Tata Steel as well has come out with its quarterly numbers. You've got the EBITDA performance, which has scaled up, and they have put out a profit this quarter versus a loss. That's stock though under pressure. Tech Mahindra in the spotlight on the back of earnings, a 3% sequential gain. Their overall total headcount, though, is down, and revenues are flattish on a year-on-year basis. But by and large, it's been a pretty decent quarter. 1339 is where it's currently settling at. A whole host of other numbers. Aarti Drugs, for instance, margins are absolutely stagnant. The EBITDA as well is down. No wonder then that you're seeing a 6% gash. Balkrishna Industries as well. The stock is in the spotlight on the back of numbers. A pretty healthy set. Stock up 1%. Blue Dart Express has come out with its quarterly performance. Margins are down, revenues have come in higher. And quickly revisiting what Birlasoft is up to as well, given that their PAT has grown about 11% QOQ, and margins as well have come in higher by 22 basis points. SIAT, Chalet Hotels, Container Corp, DCB Bank, those are some of the other result candidates. Meanwhile, you've also got something like a DLF, which has come out with its quarterly numbers. Incidentally, the highest quarterly new sales bookings that the company has delivered. A PNB Housing Finance, another result candidate, while Quick Heal Technologies has put out a bit of a mixed set of numbers. Watch out for RailTel as well, which came out with its earnings. Margins have expanded this quarter, and something like a Sagar Cements. Forgot TVS Motor, by the way. That stock as well will be in the spotlight. Highest revenue, EBITDA and PAT that they've delivered in Q3. Remember, we were talking about that turnaround in some of the two-wheelers, but not quite reflecting on the stock. Z Entertainment, the saga only continues. Now they're going to NCLT, seeking directions for the merger scheme. That stock at about 165 is under a bit of pressure in today's trade. Mazgaon Dock as well. The contract that they have received, 1,070 crore rupee one. So that's stock 2 in the spotlight, and yeah, some of those liquor names as well. So check in on the likes of United Spirits, etc. in the spotlight. Okay, Kunal, what do you make of the market open this morning? Is there anything specific that's catching your eye?
Well, yeah, so I think it's a flattish kind of an open for the indices. Let's see how the Bank Nifty shapes up, because I think that's going to be an interesting index to watch out for, specifically looking at the expiry as well as the effect from many of the private sector banking names. Now, the stock which I would look to trade in the open would be from the IT pack, and Wipro is something which looks attractive. The stock has come back towards a good support closer to 475, 477 mark. So, would look to trade this stock in the open.
All right, so Wipro is a first opening trade from Kunal. Kenneth Andrade is now joining us to talk more about markets, how they are approaching, and of course, the new entity which they are floating. Kenneth, first of all, congratulations on the mutual fund foray. I'm sure a very large part of your followers and your admirers would be logging in along with a new breed of investors who are actually taking shape in India. We'll come to that in a moment. I want to understand your, one contra call which we've been speaking about since early morning today is metals. The way some of these metal counters are coming out with results, Tata Steel, for example, and you are in one of the minority side of the market which believe that actually metal converters or the Indian companies are a good bet, especially in an argument when they're saying US and Europe is weak, metals may not do well. You believe that they could be good bets. Is it the improved balance sheets you're betting on, or is it the India demand story? What exactly is the hypothesis there?
When you look at the entire commodity basket, and specifically even in steel, balance sheets are not what they used to be, or the financials are not what they used to be in say 2015 to 2020. A lot of these businesses have been generating enormous amount of cash and also expanding capacity at the same time. So obviously it's a volume game, and we remain competitive across the world in terms of profitability per ton. Now, the only call that needs to happen, right, and this is through 24 and some part of 25. Okay, is steel prices actually going to move up? And if steel prices actually move up, you can cash in on the next recovery of these prices. So valuations are as cheap as you can get them in a down cycle with a completely solvent balance sheet. So it's a matter of time and patience. We are not taking a call on the cycle because we do not know what really is when will steel prices actually rebound. But 2024 calendar year, you will get a reasonably depressed environment as far as commodity pricing is going. But this should be the low point in companies' profitability. At this profitability, they are still reasonably valuable, or should I say, very valuable.
Fair point. Right. Kenneth, the other very interesting name which I see in your recent editions is one name from the premium liquor segment, which is making a lot of waves. This part of the premium liquor or some of the other premium categories of the consumption basket have been doing phenomenally well, even when rest of the mass segments are doing bad. What is the hypothesis of adding premium liquor segment in your portfolio recent editions? Is it this company specific, or you like the category?
So it's company specific and the category itself, but the category is trading upwards. Look, India is amongst the top countries in the world with the per capita consumption of alcohol. So to tend to believe that we will consume more alcohol is not the right way to go. So once you've been able to get that base of users, you basically have to ride on the per capita consumption of per capita rise in income, which will create a premiumization trend that is there. So what's happening not just in the liquor market but the rest of the categories also is everywhere where there's a premiumization of the category, that category is done reasonably well. At the bottom end of the pyramid, in the bottom end of the consumption pyramid, you're seeing the reverse working around. I mean, the reverse in that sense is people are down trading. They're consuming the same amount of volume, but at a lower price point. And that's happening at the bottom end of the pyramid. So consumption in India is actually broken up into two extremes, right? In the premium top end of the consumers are premiumizing with volumes, and the bottom end of the entire population pyramid is consuming higher volumes but at a lower price point, which is creating a margin pressure for a lot of businesses at that end of the consumption spectrum.
Hi, Kenneth. Morning. Given that we were really banking on support coming in from the FII community, 30,000 crores though that we've seen in terms of a net sell figure over the last few trading sessions, is that unnerving, or is that sort of a precursor as to what could transpire for the rest of the year, or are we banking on FIIs coming right back?
So India is doing well as a country, and there are a couple of other emerging markets that are also doing well as countries. But what out here for any investor, I think valuations where Indian companies trade is a very big pushback. Because there are some other larger businesses and opportunities that exist across the world, wherein the valuation trade is almost at 50% of where India trades at this point in time. So to tend to believe that we will get a continuous flow of this foreign capital when they have other choices, I think I'm on the camp where I'll be a little cautious about saying that FIS, foreign portfolio investors are going to continue to put money into a marketplace where valuations are trending high and there is very low margin of safety. So I'll be a little cautious this year to tend to believe that will happen. And there are other markets around the world which are underperformed quite dramatically, which would get their fair share of capital also. So India is dependent a lot on their domestic capital flows right now, and we've shown in the last 3 years or 2 or 3 years that domestic cash flows or domestic investors are far larger than what foreign portfolio investors can be, and that structural change which has taken place is here to stay.
One thing which I find missing from your list of the holdings, at least what I'm seeing, is the lack of large cap financial names. That's the private banking names I'm talking about. Have you been averse to that for any specific reason?
It's not a trade that we've participated in for a very long time. Actually, all of the last 5 or 6 years, we haven't participated with that trade. We've got a large lending name out there, but it's more of an NBFC. And to that extent, we tend to like the NBFC space a little more than the private banking space, so as to say. I mean, the opportunities as we see it is, and as the entire industry also sees it, is in unsecured lending, and that's a book which is growing significantly fast, and there is reasonable amount of demand. Plus, you get a higher yield also on lending out there, as long as you can control your risks. So that's where we're tending to navigate our portfolios, or tending to look at companies or businesses in that spectrum. So lending businesses are on the table, but as portfolio managers, we may not be. We'll stay out of the banking space at this point in time.
Okay, so that's interesting. So a two-part question. What will make your view change on the large cap financials? When you see value on the table, will you be looking at that? And secondly, you talked about unsecured lending being the growth driver. In that context, are you looking at adding some of those microfinance names which have been doing quite well of late?
I mean, nothing will change to make me. We're not looking for anything to change to recalibrate our thought process out here. And it's not that banking as an industry is doing badly, or lending as an industry is doing badly, because you have to go stock picking in that segment of the market right now. You have a bank which is doing very well and is hitting 52-week highs, and you have another large bank which is hitting 52-week lows. So it's basically a company problem, and it's a company problem if you would say that. And it's not really an industry problem. So category profitability is growing. You just got to move towards a place where the profitability is growing at a significantly faster pace than the broader GDP. And I think that's where we are moving towards. So to that extent, I mean, any business that we come across, like I said, we've got one large financial NBFC which is there. But we have opened up the entire category to see what really fits our investing profile.
Okay, Kenneth, wanted to understand how investors can really unleash the opportunities within the entire power space as a whole. There have been a lot by way of renewable energy stocks that have been in the spotlight, the schemes that have been announced by the Prime Minister, a sector as well that you look at. Can you give us your take?
That's a difficult one. So you will have to go with the, I mean, if you want to invest, and this is not really in our domain right now, because virtually every business out there is coming at a price point, and on a promise of the future, at a price point and the promise of the future. So if you have to put a portfolio together, you have to play in the direction of the news flow or the projected news flow, and figure out companies and categories that will participate in that in that part of the growth of the economy. So power as an industry is going to be very large. It's always been significant. Energy cost as a percentage to total sales would be anywhere between 11% to 15% of individual companies' cost lines. Okay, so it's a large industry, but now you have to play in the direction of that entire industry. But one thing is very sure, that power costs are going to be inflationary. Inflation is very good for company profitability. Profitability is very good for cash flow. Cash flow is very good for incremental capex. So you're in a virtuous cycle, and because you're in a virtuous cycle, These companies are priced at where they are at this point in time. I mean, obviously there is a space or two in the energy space which is reasonably priced. Um, a lot of it is trading like it is a sunset business, and I'm just highlighting it. I mean, a lot of it is in the oil and gas space, uh, and that's probably the only opportunity that is around there. But you've got to tread a little carefully because valuations of those industries depend upon what you would assign a terminal value to those businesses. Okay, and if it's really a sunset industry, then you won't get a real price earning re-rating like you've seen with the rest of the power companies or the contractors that address the power companies out there.
Kenneth, I see that you've added a lot more pharma names as well, whether it's Glenmark Life, Marksons Pharma, even Syngene or Aurobindo for that matter. What's the thesis when it comes to the pharma names?
I mean, a lot of it is already playing out. Like, step back to the last quarter numbers or even in 2023 numbers. You've hit the trough as far as the profitability is concerned, and now it's all incremental amount of growth that is there, and all of this growth is coming at incremental market shares that are happening across the world. So all these names that you did mention, and probably a lot more of them that are there, are addressing international markets of the rest of the world, including the US. And I think that's where the profit and that's where the pricing will emerge for a lot of these companies. So that's been with us for a while. We think, I mean, balance sheets are completely clean. Cash flow generation at its all-time high. And for all the companies that are there, that are addressing the West, volumes have started picking up. Now we got to see how margins come through. And margins will come through because, and margins also are not too much of a problem because you're starting on an extremely low base, which was in 2022. So margins will also come through. How large can these guys get? I think what you're seeing with numbers coming through is all companies are reporting a very good growth in volumes. We've got a margin pressure out there, but that's just the pricing environment that is there. All incremental capacities that these companies have also set up, and they've been setting up all capacities. They've been through a capex cycle over the last 3-4 years. They're yet to get utilized. So 2024 calendar year, a lot of Indian businesses in pharmaceuticals have their largest capex cycles going on stream. And incrementally from 2024 onwards, you will see volume growths. We haven't been able to get a handle on how profitability will grow, but that will also have a similar growth compared to how the top line or the turnover actually grows with these companies. So we are fairly constructive. It's also our largest holding in portfolios right now, and they don't trade at very abnormal valuations. They are higher from their baseline, but they don't trade at very abnormal valuations.
In fact, I have a follow-up on that one, Kenneth. I was watching, I mean, not going into the name which you have actually added, but I want to understand one of them has a very big valuation re-rating opportunity, which we saw because the debt reduction happened. One of the few companies in pharma which had big debt, that started coming down. Plus, other part of the business, there was value unlocking. The other one is actually seeing very sharp outperformance on the EBITDA generation. If the previous quarter number was anything to go by, do you see these two play out from here also? Yes, they have kind of moved up, higher EBITDA and of course valuation expansion as well.
So yes, I mean, for the companies and the stocks to do well, now the denominator has to start moving, which is basically EBITDA earnings. And for those two to do well, you should have had capacities on the ground, and you should have gone through a capex cycle. I think the latter has happened. The former now has to play catch up in terms of the profitability the capex is already on the ground, and the former, which is profitability growth, should start happening. And it's not going to be a company or two, it's got to be an industry. industry that grows profitability. Then if the industry's profitability pool is expanding, and we think it's going to be quite sizable in the next 5 years, the Indian companies or all Indian companies, all companies domiciled in India, which also have a few operating companies across the West, they will play into this profit pool expansion that is sitting out there. So I think that's what the opportunity, and that's where why it's also one of our largest exposures in our portfolios.
Before we let you go, Kenneth, congratulations for the foray into mutual fund space. Talk to us about what's the plan, because I see many of your peers also doing the same, and suddenly this space is hotting up. I'm told that there's big dearth of quality talent. I'm sure competitive landscape would also be slightly, stronger. What are your plans there?
Well, we've been in the asset management business for the last 7 years with a license. This was on the portfolio management space, and we did a few alternative investment funds also. This is just an extension of our product profile into the mutual fund category. Now, with the mutual funds, I think we can address investors from 100 rupees investment all the way to the HNIs, where we do have portfolios, or we do have family offices who contribute, who are investors with us, or who are investors in our funds. So I think that's the only extension that is there. Yes, you mentioned it right. It's a very competitive landscape, and across the world, it's a very competitive landscape. It's also it is also getting reasonably fragmented. So you have to find a niche. You have to build an investment style, investment team, and concentrate on what you do best. So for someone like us, which is or someone like us who've always been investment led, you would not see us build out a very large distribution base. We will lead with an investment style and investment portfolio, take it across the marketplace, and once the thought process is built through, then I think organically, like we've seen in our other asset management vehicles that are there, the investors would hopefully align with someone like Old Bridge.
Okay, good to have you on board. Interesting conversation there with your view on the markets. Let's just move on then from that and put the spotlight as to what exactly is going on when it comes to Ujjivan. Small finance bank. We've got Ujjivan Itara Davis, who's the MD and CEO, now joining in. Thanks so much for taking time out. Let's talk numbers. And you've delivered a strong growth number. Your net interest income as well has grown, but your employee costs have shot up about 40% on a quarterly basis. What led to this uptick, and how should we see this trend going forward?
The employee costs actually is a good point to discuss, because that is investment for the future. We have in this year put together about 100 branches. It will be 100 by the end of the financial year. And last year we had 50 branches. Now these branches have to be manned. They have to be set up and ready to go. The gestation period is around 18 months on an average. Could be less in some cases, like we have seen in Telangana. So all of these are investments which we are making for the future. So there is always this leading and lagging. You cannot be perfect timing on this. So some of the expenses is we have hired a lot more people. We started the year, we have added about 5,000 staff during this year. And that is investment for the new branches, for the new businesses that we are putting together. And I think it's all moving in the right direction. Between one quarter and the other, there can be some, slight variations.
Okay, point taken. So that's the view coming in as far as the investments that you are making. But I also wanted your take regarding some other numbers as well, because if I look at the branch addition as well, your target was around 45 for the second half of the year. We have already seen 29 additions. What's the target of FY25 now in terms of the growth in terms of the branches going forward?
No, we have put in place, between last year and this year, this financial year, 150 branches. We will add to that during the next financial year. But our objective in 24-25 is to make sure that these branches which we have put in the last 2 years become profitable and are able to provide all the services that our customers need. So that is the objective. We will add to that selectively, but post-COVID, for 2 years in COVID, we didn't add any branches. So we have caught up. We are happy with that, and we will be moving forward. But in line with the branch network, we are also pushing very hard with our digital offerings, and I think that is a very important part. Digital will now come to play a role on the side of the brick and mortar, and these two together will be the way in which we grow our business. Because a branch is a fairly expensive proposition when we look at it. And I think this is a good way to supplement that with digital.
No, sure, but I understand that. But you do, you will add the branches as well, right? And you said how it's expensive affair. So what will it mean to the cost to income ratio going forward?
Yeah, next year we are looking at a maximum of about 50 branches. So it's not as much as this year. So to that extent, the overall cost structure will be less in 24-25. And, it again depends on the timing when these branches come in, whether it's in the first half of the year or in the later half. But having said that, I think, the organization and the bank is very well focused on growth. We see, potential to continue in the businesses that we are doing, and we are adding a few new businesses as well, which will help to balance the secured and unsecured portfolio.
Okay, so how is the growth in the unsecured part of the portfolio going? I know you want to move it, the mix, you want to move the secured part to 40%. How's the growth in the unsecured part? Because that, seems to be the talk of the town right now. Regulator appears to be, uncomfortable with unsecured, very high scorching growth. Some of the players actually are showing. What level of growth would you like to keep your unsecured part of the business?
Yeah, our overall growth that we are looking at, for this year, as we had indicated, is around 25%. And given that the secured book will have to grow a little faster to balance out, because we're trying to increase the secured book. So as far as we are concerned, I don't think the regulator will have any problem, because we are slowing down a little bit on the unsecured so that the secured picks up. So I think overall we are spot on, where the regulator would not be disappointed.
The regulator will not be disappointed, but I also wanted an update regarding the reverse merger as well. If I had it right, the hearing was expected at the end of the month, right? Is there anything fresh that you can share with us with respect to developments there?
No, we are waiting. 30th is the scheduled date of the hearing, and we hope everything goes well and we get the go-ahead, in which case, we are looking to complete the process by the end of this financial year.
Okay, point taken. I also wanted to understand in terms of the secured loan book. I think the target was to achieve the number of 40% by FY26, and you're already over 28%. You did allude to the fact that, there shouldn't be worrying on the unsecured business, that you're already going slow. But with respect to the secured book, are you confident of meeting your target or even ahead of the set expectations?
No, in looking at the secured portfolio, we are growing fairly well within the secured portfolio, but we have not closed out any inorganic growth options, which we will consider next financial year if it is a way in which we can get to that target faster.
All right. And can you give us a sense before we let you go in terms of your target for net interest margins? 9% for FY24. We're already at 8.9%. Does this indicate an uptick in the next quarter? Will you be revising your targets?
No, we have said 8.9 to 9 is our guidance, and I think we will stay with that. We have done certain adjustments in terms of the business to be able to improve yield a little bit, so and the margins. So hopefully this quarter will be slightly better than the previous 2 quarters. But overall, the guidance is for 8.9 to 9%, and we'll stick with that.
Okay, on that note, we let you go. Appreciate you making time and speaking with us. But let's shift focus and talk about Amber Enterprises, because that stock is in focus on account of the tie-up that they have done with respect to the railways segment of the company as well. We have with us Mr. Jasbir Singh joining in on the show, the Chief Executive Officer there as well as the Chairman, to talk to us about this latest development. Hi, Mr. Singh. Good to be speaking with you. That's exactly the first question. You have been talking about how you're looking at expanding into other categories as well beyond the room ACs, and it seems to be happening. Talk to me about what kind of potential do you see in this entire railway segment, because there's a complete overhaul which is happening of the railway coaches back home. So how big an opportunity could it be for you?
So good morning and thank you for having me on the show. We are very excited for this new announcement with Titagarh. We see it as a very win-win situation. So it has got three components to it. First of all, since Sidwal, our railway mobility application business, we are delivering solutions in space of air conditioners, doors, gangways, and pantry systems. So we will be creating another SPV with Titagarh, where we are going to bring interiors and other components, which for us will increase a very big TAM. Now, looking into the kind of announcements Railway Ministry has done and Urban Development Ministry has done for the metro coaches, we expect this total addressable market to go to almost about 75 to 80,000 crore for the kind of order book which is coming. So in next 5 to 6 years time. So we expect that Sidwal, our subsidiary of railway application, can multifold grow on this venture with Titagarh, where we will be creating a complete, comprehensive and integrated solutions for the complete rolling stock manufacturers, giving them complete integrated solutions in terms of almost 25 to 30% of what goes into a passenger coach.
This can be quite meaningful. I was already observing that you had moved towards railways before this particular tie-up was also announced by HVAC, the heavy air conditioning side. So it appears that railway opportunity in layers in various segments could become a very big opportunity for you. The new Titagarh is of course a wagon side, and you're talking about the parts to it. We already saw HVAC. Can you throw us a big picture in the next 3 to 4 years how railway could become a part of your overall business?
See, today we entered into railway business in 2019 by acquiring Sidwal, and first of all, we started re-layouting our factories and getting it ready for the metro coaches as well as for the complete air-conditioned coaches. Today, we have a dominant share in the metro space as well as in the railway air-conditioned coaches. But then, to increase our wallet share within the existing customers, we thought of a strategy where we can leverage our group strength and also give a complete comprehensive solutions in the complete railway coaches business. Now, if you see the announcements made by Ministry of Railways, almost 3,000 new Vande Bharat Express are going to be launched, and one Vande Bharat Express is having 16 coaches, and we want to address almost about 2 to 2.5 crore per coach as a bill of material solution provider, giving solution not only for air conditioners but for other equipment which rolling stock manufacturer buys from outside, like doors and gangways, pantry systems, gears, couplers, interiors, toilets and seats, etc. So we are forging some more alliances in this SPV to bring a complete ecosystem of the consolidator solution provider in this railway business.
You said 2.5 crore is what you're targeting per coach, and the total addressable market is 70 to 80,000 crore if I had it right. But what part of the market share are you expecting to win? Because it's also getting a bit heated in terms of this entire cooling segment, right? You had a lot of MNCs already doing this work. What's the USP that you bring to the table then? Is it lower margins at all, or what kind of margins are you expecting on this?
So we have in Sidwal, we have 20% EBITDA margins currently and almost 40% of return on capital employed in that business. It is a very good business with very high entry barriers. And similarly, we have chosen the products which are very high entry barrier products, where the gestation period is almost about 5 to 6 years. That is what we have chosen to be in. We are bringing in more parts to be supplied to the rolling stock manufacturer. And since we are very large in static application of air conditioners, that's why we get the purchase leverage, and having 29 plants, we get the geographical advantage also to supply to our customers.
Can you give us a sense then as to your intentions as well of diversifying away from only AC, as to what exactly you would be looking at? How much of a potential benefit would that be from the company? What would the overall mix look like?
Well, for Sidwal, if I talk about, we are sitting at an order book of almost about 1100 crores. So that we expect this to double with this announcement because Titagarh already has 80 trains Vande Bharat coaches order in hand, and we will be supplying air conditioners plus all the Sidwal products to for their Vande Bharat requirements, and also for their metro coach requirement, because they have order book for Pune Metro, for Ahmedabad and Surat Metro. And of course, for us, this is one of the strategic tie-up where the Titagarh have their facility in Italy also. So till now, we were not having experience in the global play. We were lacking in the experience. So this venture with Titagarh will also give us a global play, where we will be supplying air conditioners and other products in Italy also. And that's how we will become eligible for global tenders going forward.
Clearly, the market and the street is really loving your diversification strategy because you are going in a very calibrated manner. Your acquisition of PCB, that is also something which people really liked on the street as a part of your overall diversification. How is that progressing, and some color on what shape it can take going forward in terms of opportunity?
We entered into electronics in 2018 by acquiring Ilgin, because at that time, air conditioner industry was traveling from fixed speed to inverter AC, and in inverter AC, the largest contributor of bill of material is the PCB board. We were not having at that time, so we acquired majority stake in Ilgin, and that's how it started growing. But eventually, after achieving our objective of supplying to the industry, we saw that we can get into the adjacent markets, and we started expanding into wearables. We started expanding into telecom, into auto space. Now we've cracked the smart meters. And what we saw was that PCB assembly, 80% of the components, whether active or passive, is getting imported. And looking into the Atmanirbhar Bharat campaign and agenda of our Honorable Prime Minister, we thought that we should get into backward integration. And that's how we acquired Ascent Circuits, which is the bare PCB board manufacturer. And we have also done an MOU with Korea Circuit recently, which is one of the leading player in the bare PCB board category, supplying to semiconductor industry and also to mobile industry. So they will be also participating with us, and we will create the whole ecosystem of passive component, especially in the bare PCB board and PCB assemblies in various applications. So we see a multi-fold growth coming in the electronic sector. And I think that is purely becoming number 2.0 business strategy for us.
So multifold increase in the electronics business. You're saying the share of railways is expected to double, and you talked about how margins for this particular JV is 20% with ROCEs of around 40%. If I have it right, your blended margins right now is around 7%, with ROCEs being below 20%, actually 9%, single digit. What will the total blended rate look like now, given the additional businesses coming at a very lucrative number in terms of margins and ROCEs?
So we've already guided the markets. Last year we've touched almost 14.5-15% of ROCEs, and in next 3 years' time we should be in the range of 90 to 21% of ROCE on a consolidated basis.
The margins on a consolidated basis then?
Well, we are improving the margins. Very difficult to comment right now because margins in percentage terms are functions of commodity as well as the sub-assemblies which we do. But there will be some margin expansion also on the consolidated balance.
About the top line itself, this entire EMS industry has been growing at a CAGR of almost 35-40%. What do you envisage for yourself? What could be the growth for you? A long-term number, let's say next 3 years. What would be the CAGR growth that we should expect, given the diversification that you're doing into newer segments?
See, if I talk about the three divisions, the railway division, anyway, we are looking to a multifold growth from where we are today. As per after this joint venture we have just announced, I think we expect that in next 5 years' time, Sidwal has a potential to go at least 3 to 4 times of what it is. And plus, we are creating another ecosystem which will be almost as parallel to Sidwal in a 50-50 JV. On electronics, of course, there's a lot of potential now. Since we are into bare PCB board, we shall be attempting our exports also, not only India market, and we are also excited by the multifold growth there. We expect that it will be in line to the EMS projections, what it is there. And since we have added smart meters, we have added telecom businesses, we also expect a good chunk of growth coming in from that sector. So overall, I think we are excited that all the three divisions now, in 5 years' time, have a multi-billion-dollar opportunities coming on the table for next decade, and that's what we want to leverage on.
Sorry, I just wanted to scratch that point further on the smart meters, because that's something that you're saying could be a multifold opportunity, as is others. A word on that, and also with respect to the budget impending, is there something specific you're expecting for the EMS industry, or a lot has been done through those PLIs already?
No, I think government has done fairly great work, I would say, and thanks to all the initiatives of whether it is MSIPs, PLI, specs, government has given so many incentives, and state governments are giving further incentives. So it is right time for entrepreneurs in India to take bold and brave steps, and leverage the consumption potential of India. For the budget point of view, I don't think so that there is anything pending. Only the phased manufacturing program implementability, which was recommended to government 2 years back, we expect that that is in line. So as there will be some custom duty increases in the compressor side, now we see almost 5 companies coming in India and putting up compressor plants. So is the case we are expecting in the motors business also. So that's all our expectation from budget.
Before I let you go, I sense a lot of high growth potential in all your businesses, the legacy as well as the future businesses. I want to understand what is the capital intensity of these businesses? Would you be requiring to inject fresh capital? Are you adequately capitalized right now? What will the capital requirement be? And would there be a need for a small bridge capital raising in the interim?
You see today, for our air conditioner business, component business, we've already done with capex. So that business doesn't require any much capex now moving forward for at least 3-4 years. We will be doing some capex in the bare PCB board segment, as well as a new facility which is being set up in Sidwal. But it will not be large because asset turns are very good there. In electronics, we have asset turns of almost 10 to 11. And in railway application, asset turns are further more. So not a very big capex which is coming in. But in case, some inorganic growth story comes in further, then we'll think about it. But at the moment, we are not thinking about raising capital.
We'll let you go on that one. Thanks so much for joining us and giving us the roadmap, the new businesses which are lined up at Amber Enterprises. Well, look at the last 3-month chart, and you would see how the stock smartly has moved from 31 odd rupees a share piece to closer to 4,000. This after languishing for a very long time. So Street really loves the word of new business, especially railway is the buzzword. But we'll move on now and get you PSU Bank in focus came out with the results. Mr. Satyanarayan Raju, MD and CEO of Canara Bank, joins us now. Let's talk with the operational data, Mr. Raju. This quarter reported a dip in your pre-provisioning profitability by almost 2%. Want to understand what was the reason for it? Was it one-off in nature? Your employee costs have surged and cost to income also has surged. What is it likely to remain elevated, or you see it peter out going forward, normalizing going forward?
It's not a continuous system, it's a one-time measure. You might be aware about that the Employees Association and the IBA has entered into an agreement for sale agreement, the wage revision agreement in the once in a 5 years. The latest agreement is due from the 1st November 2022. So last 14 months, we were providing that in anticipation of the growth, the incremental wage revision will happen at around 14 to 15%. But when we realized that recently that wage agreement has been concluded with a 17% growth rate. So from November 2022 to December 2023, that 14 months, we calculated an actual basis, whatever it is there and at 17%. And what we have already provided and the minus whatever is the difference, the entire 700 crores has been provided now. Actually, every month we are providing 115 crores. Now it is 129 crores per month it is required. So whatever the gap is there, that additional 400 crores we have provided in this month towards that meeting the requirement of the wage. In addition to that, we also provided towards the retirement benefits of these incremental benefit. Actuaries, a major part of that actuaries also around 250 crores that also we provided in this. That is the reason actually total 700 crores additionally we provided. That's the reason you are seeing some 2% dip in that gross profit. And it is shown reflected in the increase in the employee cost. But it is only one time. Just we want to observe that since the agreement is already concluded.
Right. So you've reported a flat net interest margin this quarter. What is the outlook in terms of your net interest margins for the coming quarters? Interest expenses are growing faster than interest income. So what would be the key drivers?
In the last quarter also, when I interacted with all of the market, that we clearly mentioned that there is a pressure from the cost of deposit. If you look at even in Canara Bank, the cost of deposit is increased almost 6 basis point, whereas the yield on advances is increased only 3 basis point. That impact pressure is there on us. Even NIM. Last time we are told that our expectation for the current year is will be around 2.9 to 3% the NIM. But we are trying our best to utilize the optimum resources, whatever available well within that. We are repricing our corporate loans where we want to do that. And we are focused more on RAM sector. There we get higher yields. And we focused also at the simultaneously on the credit cost by reducing the slippages and the quality of the recoveries and an NPS. All these things are helping us to maintain at above, just above the 3%. But the next quarter, again, I continue with my what earlier I shared with you that it's our NIM will be between the 2.9 to 3%, but our efforts will continue to be nearer to that 3%.
So NIM's closer to NIM's closer to around 3%. But what about CASA? Because a lot of peers have talked about how that is expected to be under pressure. What's your expectation of hitting that 35% target?
This one particular parameter still actually it was an ambitious target for us. We kept for 35% because we were struggling with weak CASA among the peer banks. But because of the market conditions where the liquidity issue is there and there is a heavy demand for the liabilities, competition is high, rate of interest are very high. Many banks are offering very high rate of interest for mobilizing the liabilities. That reaching that 35% will be a little difficult for us. But our growth, whatever is the last year on year, we have grown in the CASA at 5.05%. But still, this current quarter, we are thinking that whatever the growth we targeted for the deposit, the same growth we want to reflect in the CASA also, so that our CASA growth year on year at least will touch 8%, which we are declared initially that the deposits will grow at 8.5%.
Right, and what about your credit costs? That went down and slippages too were lower. Give us a sense as to how you're looking at that panning out, because your NPS from MSMEs and corporates look elevated. Are you seeing any stress building up in any particular areas of your loan book?
So actually, these are all not the new loans what we are finding that NPA. Whatever the just 3-4 years back lent, only those NPAs only we have seen. But if you observe for last 2-3 years, our NPA in the MSME has come down from 14% to 8.5%. It has come down. The reason behind that is last current year we are reframed all our schemes. We tightened the onboarding systems, but we somewhere where we have a low stress in that portfolio, so specialized area wise schemes we introduced. That's why if you can see last 3 years, current year MSME growth is higher. Almost we are touching the double digit 10% growth, but the slippages gradually it is coming down. And the same case in the case of the corporate also. The corporate, whatever the last 3 years what we have sanctioned, none of the account is reflecting in the stress even in the SMA 1 or 2. These are all the legacy accounts which we already converted into NPA, and now we are only focusing on recovery of these accounts. But I don't see that any fresh slippages in these sectors, corporate sector. But nominal slippages will be there in the RAM sector regularly. But that's a part of the our business concern. But our recoveries are much more than what we are allowing the slippages.
Also, Mr. Raju, if you can talk about how the deposit growth is building up, because that appears to be the biggest challenge right now for the entire sector. Are you also witnessing any pressure in that pocket on the deposit building up?
Current financial year, from 1st April onwards, our retail term deposits have grown in absolute number around 31,000 crores. And we see a good traction in that retail term deposits in our both in the 444 scheme as well as in the 1 year bucket. So we see that the continuous, it is there last, if you compare for the last 2 years, the current year growth in the retail term deposits is much better. So at this moment, I don't see any pressure on canvassing that retail term deposits, because in every day we see that the accumulation is in triple digit. So that will continue for this quarter also. But only our concern is our CASA is not growing the way the other deposits are going. That's why there is a special campaign we have started from 1st January onwards with special incentives to all the outlets. Entire machinery is focused on liability campaign, especially for the CASA campaign.
There is a bit of a pressure when it comes to the CASA, but separately I wanted your word regarding the unsecured part of the book, because of course RBI has asked to increase the risk weights there. Commensurate to that, have you increased the interest rates on your unsecured lending already, or what's the gap that we should expect that it will start showing in your numbers?
Yes, we have increased our clean loan portfolio. What is 35 basis points in that rate of interest? Because of the increase in the risk weightage, our capital has been impacted with 52 basis points. That's why partly that we want to share it with our NBFC concerned NBFC clients also. And thanks to that NBFC clients, 95% of clients have come forward and shared that liability, the burden to some extent on negotiation basis. In 1 or 2 cases where it has not happened, we asked them to repay it and we have taken that prepayments.
And there's about 7,500 crore worth of bonds to be issued. How do you plan to utilize these funds?
No, this is for capital. What we are actually the board has permitted us to raise that 81 bonds and the tier 2 bonds. It's a 7,500. 3,500 crores is for 81 bonds and 4,000 crores is tier 2 bonds. Tier 1 bonds, we have recently has gone to the market in the last December first week or second week that we could raise 1,400 crores, 1,443. Actually, we have gone for market for 1,000 crores and within keeping in a rate at 8.4 expectation. But at that rate, we got more funds. So we absorbed that 1,400 crores entire thing. The remaining 6,100 crores, we can raise in this current quarter, but subject to, again, favorable rate of interest. If our rates are comfortable, if the market conditions are conducive to in our favor, then we will rise in this quarter. Otherwise, we may go in the next quarter. But definitely, our condition is we want to rise it in the next 2 months, but we are very much concerned about the rate of interest.
Mr. Raju, we'll let you go on that one. Thanks so much for clarifying your numbers, and that's why perhaps a very sharp recovery in the stock price, 3% higher from yesterday's lows. We'll take a short break. On the other side, more news and analysis. Don't go anywhere.